oil stock because of some event, or you might want to suddenly switch all your portfolio allocation to bonds or government bond because of some event. But generally speaking, it will be a very smooth and continuous adaptation of capital allocation from one day to another.
Interesting. And how do you measure success? Are you looking at Sharpe ratio? And if so, what Sharpe are you looking for to allocate to that model?
Yeah, by default, portfolio optimization, typically the default objective is the Sharpe ratio of a portfolio. That, after all, is what the Markowitz portfolio optimization method would recommend. They would recommend, for example, the tangency portfolio is the one that has the highest Sharpe ratio. But that doesn't have to be the case. So some portfolio managers prefer portfolio to have the smallest expected drawdown. Expected shortfall or conditional VAR. That we can use that as the objective. Others want to have a minimum drawdown. We can also use that as the objective function. For me personally, for my trading strategies, Sharpe ratio is not most important. What is most important to me is what people call the Kalmar ratio or the MAR ratio, which is the compounded annual growth rate divided by the maximum drawdown over some look-back period. That is my preferred metric for a strategy. But it's really up to the portfolio manager to decide.
Absolutely. What Kalmar ratio are you looking for?
Well, of course, the minimum we want to have is 1. But if you can get up to 2, you are, in a very happy place. If you can get to 3, you are really one of the top 1% of traders, really.
Amazing. Ernest, I've heard you talk about long tail events, and you could have an algo that just runs once every 2 years. Can you talk to me a little bit more about long tail events, what they are, and just explain it for the audience?
Yes, there are many names to this kind of strategy. One is long vol. That means you're buying volatility. You benefit from increasing volatility. Another name is called a tail hedge strategy, meaning that this strategy will generate alpha when you have generate return when there's extreme moves in the market, or some people call it crisis alpha strategy because it only generates alpha when there's a crisis, which is essentially an extreme event, extreme movement in the market. And finally, some people call it convex strategy because if you think of a convex strategy like a U-shaped strategy, the equity in that strategy will sharply go up as you move further from the mean. Whereas if the prices will remain close to the mean, it's very flat. You don't generate much return, but the return that they generate sharply accelerate as you go farther from the mean. That's what people call the convex strategy, as opposed to concave strategy, where when market price move away from the equilibrium, you suffer big loss. That typically is what happened when you're short option, right? If you're short options, you have a concave strategy because ideally the price doesn't move and your option expire worthless. But if the market moves significantly, you'll be deeply in the money and your position can generate unlimited losses. So long vol strategy is the opposite of the kind of strategy that many option traders favor, which is shorting volatility.
How do you go ahead and backtest your models to build confidence?
Well, there are many standard backtest platform out there, but generally speaking, we would just backtest it using standard programming language, whether it's Python, R, or MATLAB, or even C#, C++, Rust, whatever programming language that you're comfortable with. And generally speaking, there are 2 ways of backtesting. One is using one of those so-called REPL language, such as Python, MATLAB, and R. You backtest using an entire array at the same time. So essentially, you have an array containing all the prices, and you generate trades on all the price all the days simultaneously, and backtest it using in an array-oriented way. It's very efficient, it's very simple, but it's also very much prone to look-ahead bias. The other way is more traditional loop-based backtest, where you feed the trading logic 1 bar at a time and generate signal and then compute a return for the next day. That looks very old-fashioned, very inefficient. It's certainly not an array-driven approach, but it eliminates the possibility of look-ahead bias, or minimize it at least. And so these are the general 2 methods of backtesting can be implemented